Good morning, everybody. Welcome to the ARMR Investing Morning Meeting. We're going to be talking about the stock market, talking about big picture macro, how we're managing capital. We have our three different strategies that we use to capture alpha and protect capital. It's a very heavy heart that I have this conversation. I appreciate you joining me this morning. The last 48 hours in Israel has been medieval, tragic, horrific. I have friends and family there, so it's difficult really for me to sit down and have this conversation. It was hard to write the ARMR captain's log this morning, but markets are going to open at 9:30 and we have a portfolio to run. So I'm going to walk you through stocks to watch and discuss with you a bit how the war unfolding in the Middle East I would expect to affect the stock markets. And then, of course, our job is to use that as a goalpost and read and react to what's actually happening. So I'll give you some levels on, if, X occurs, how I'll execute it, if Y, what I'll be doing. So before I dive in, this is a virtual hedge fund experience. So you're the portfolio manager on the desk. Take the information I'm sharing, figure out how it fits your risk tolerance and your goals, make your own decisions. And what we like to say on this desk is be the smart money. Take the information you hear and then be the smart money and execute your own strategy. So this is a conversation about investing. I'm not going to make it political. I will make one comment that I think is important, and then we'll move on to how this all affects portfolios. What occurred over the weekend is nothing short of horror. It is terroristic in every way. There's no excusing it. There's no coming up with scenarios of why it's acceptable. It's just pure and outright disgusting. And what I want to say is there will be the narratives that come out trying to explain away why a group of people would act worse than animals and attack women and children. And I just want to share with you real quick that that narrative, people pushing that narrative, either have a total and deep-rooted lack of understanding for the history of Israel. And they, and they push that narrative out of pure ignorance because they just don't know, or they're pushing it out of malice. And you have to be very careful of anybody pushing that narrative. To assume that the acts that were done over the weekend had anything to do with an occupation or a Temple Mount issue is to misdirect away from the heinous nature of the crime. So I'll leave it at that. There is a tie-in to the stock market here. Why would I make that comment? I think we've been desensitized over the years, over the decades, over the years. We've been desensitized to these stories that come out of Israel, come out of the Middle East. And so I hope this shocks anybody who's listening awake a little bit so they understand what's occurred in the last 48 hours. This is not the same thing you've been reading on and off for the last X amount of years. This is something way past a line that anyone could acknowledge, who was willing to be honest intellectually. Anybody who's intellectually honest would recognize this is way past any excusable line. And so what's happened is it's ratcheted up a situation, and we really don't know where it's going to go. So how does this apply to the stock market? At its basic core, I don't want to talk about it. Like it almost seems irrelevant to me, because of the loss of human life that's occurred and what will inevitably occur. It makes managing money seem just irrelevant. But, you know, that's what we're here to do. So I'll tell you that generally when a war breaks out, the knee-jerk reaction is to sell off the equity markets. There'll be a rally in certain commodities, gold, maybe silver goes with it, energy for sure. But when it comes to equity markets, that knee-jerk selling usually gives way to buying by the end of the week. So there could be a couple ugly days, and then the buying starts. And the reason is, while all the noise is out there around you of what this may or may not do to inflation and economies and all that, that's got nothing to do with why the stock market moves. It has everything to do with central banks. If there is a destabilizing war, right, and so the world markets are destabilized, central banks begin working together to add liquidity to the market. That's what happens. So that's the goalpost that we should expect. If we see something else occurring, we have to react to that. And I would say there's something seriously wrong with the market if we take out the lows of last week. If the lows of last week give way, the market's in serious trouble. And I give that a very small probability, okay? Because if things unfold as aggressively as expected / feared in the Middle East, it would make it very hard for the Fed to continue worrying about raising interest rates. And what will take center stage is making sure there's liquidity. That would be my expectation. That's what history would show. So if that's not the case, we have to react to that. What happened last week in front of the horrible actions over the weekend is a stock market that was trying to bounce. The weighted indexes are in the process of rallying off of the 200-day moving average. We have armrAlgos set up to trade 10 indexes. All of them together make the risk monitor. We need to see more than 2 give us a risk on entry point. But at the end of the week, NASDAQ 100 and the S&P 500 weighted indexes, SPY QQQ, the algos for those indexes gave us a risk on entry point. Now, we had a huge day trading on Friday. We day traded, so we have 3 separate strategies. I like to really call it the armor carry trade. So what we do here with a significant amount of our capital is that we own U.S. Treasury bills at 5.5%, and then we use the brokerage dollar to day trade triple the S&P and triple the NASDAQ 100 weighted indexes. When I say the brokerage dollar, we don't pay margin interest if it's a day trade. So they literally allow us to borrow capital because we have 100% of our portfolio collecting 5.5% in Treasury bills. Okay. So then we borrow capital, trade it, give the capital back, get to keep the upside. That's the alpha that we're growing. It's the armor carry trade. So we had a nice day on Friday making money on that carry trade. And then we have 2 portfolios, special situations portfolio and a macro fund. Okay. And what we do in the special situations fund on Friday is we parlayed our profits. Right now, the macro fund is only executing the ARMR carry trade. So we have a day trading portfolio executing the carry trade. We have our macro fund. All we're doing is executing the carry trade. So in excess of 2/3 of our capital is in cash every night and collecting 5.5% in treasury bills. And then every day we go in there looking for volatility, trying to capture some upside. Doesn't matter what it is, 1/3%, 1/4%, 1%, whatever we can capture is gravy on top of the 5.5%. So we're doing that with more than 2/3 of our capital. And this weekend is one of the reasons why I feel so comfortable doing that. I have zero overnight risk. So while awful things are occurring that negatively impact the equity markets, we're carrying an enormous amount of cash, collecting 5.5% yield. And we're going to attack the market today. It's going to open lower, and then we're going to put that cash to work to capture upside if it's there. So it's an unbelievably conservative way to run money because we have no concerns about what happens overnight. We're just sitting in treasury bills. Now, with our special situations fund, when we had the risk on entry point in the Qs and the S&P weighted indexes, we put that capital to work in SSO and QLD, giving us twice the performance. So with less than 1/3 of all of our capital, we're capturing twice the performance of the S&P and the NASDAQ. At the end of the day, and I was sharing this with ARMR insiders as it was happening, I said, guys, you're going to have to make your own choice here. I'm going to make mine. And my choice was to hedge that position into the weekend, owning puts on the equally weighted S&P. RSP is the symbol. I think a reasonable strategy between here and the end of the year, forget about all what's going on geopolitically, just a reasonable strategy from here to the end of the year would be long the weighted indexes and short the equally weighted indexes. And I think you would capture alpha doing that. The Magnificent Seven, you've heard, all about the Magnificent Seven and the impacts on the market. Take a look at this chart right here. Okay. So this is what the 7 stocks, Facebook, Meta, Amazon, Google, Microsoft, NVIDIA, and Tesla have done for the equity markets this year. Okay. The contribution this year for 493 stocks is basically break even, actually going to be down for the year now this morning. Okay. And these 7 stocks are up. That one chart puts in stark relief what's happening to the stock market. Okay. So to be long SSO QLD, I am going to capture those 7 names. And I'm going to carry periodically puts on the equally weighted indexes to hedge it. On the up days, I'll make more money on the weighted indexes than I will on the equally weighted loss. You see what I'm saying? And on down days, they just crush the equally weighted. It's down more than the weighted. And in Q4, hedge funds that have been making money on those 7 names all year are going to do everything they can to support those 7 names into the end of the year and collect their 20%. So if I'm going to go long based on an algo, which I was on Friday and I am right now, I'm going to hedge it short with puts. How would I handle those puts this morning? If the market is down big this morning, it's only down about 2/3%. Okay. It's not down a lot, the market. I'm going to let the market open, trade for 15 minutes and see what direction we go. If we break above the opening range high and I'm putting on a long trade, because on our day trade portfolio, the ARMR carry trade will be getting long off of the low. So no risk overnight, market's down. Gives a risk on entry point on our day trading strategy. I'll Great. I just put a whole bunch of capital to work. Okay. If the market trades 15 minutes and breaks below the opening range low, I'm going to carry those puts a little bit longer. But if we get a risk on entry point, I'm going to book the profit on the puts and look to put it out again at the end of the day or when I need to hedge a position. Couple of thoughts for you. We can go over a list of stocks if you want, top stocks to watch. We can do it. But I got to be honest with you. Before I put a single stock in my portfolio, first of all, the risk monitor is red, so I don't have any interest in buying a lot of stocks. One of the major reasons for that is when the market goes down big, let's say it continues to go lower, it's very hard to manage 10 different positions. You have slippage. You're losing more money than you should trying to manage the 10 positions you thought were great ideas. This is not a market for the ideas that you think are great. When the risk monitor is green, the Fed's adding liquidity, your great ideas can soar. But that's not the market we're in. There's 7 stocks holding up the market. The Fed's reducing liquidity. If you're going to get in there and throw punches, you've got to focus on where the money's flowing, and you've got to do something that you could defend quickly. So if I buy QLD and SSO, I'm focused, I'm hyper-focused on where the money's flowing, and I can get out like that if I have to. How many positions are you looking at that you're going to add to your portfolio if the market's going up that you think can double the performance of the NASDAQ 100? How many? Somebody tells me they want to buy NVIDIA. I say, why? Let's buy Tesla. Why? Is Tesla going to go up twice the performance of the NASDAQ 100? Because if it's not, why take that individual stock risk? Just go buy QLD. You're going to get Tesla and everything else that's going up. So we want to limit our risk if we're going to put capital to work. That means limiting the number of ideas. It means focusing on where the strength is. If the risk monitor were to change and I was willing to put individual stocks in my portfolio, then I'm only going to put stocks in there that are not represented in QLD. I don't need to go by Google. It's not going to double the performance of the NASDAQ 100. But I might buy Trade Desk. I might buy Uber. I might buy whatever else at the top of my list that I think can have exponential returns if I buy it right. That will more than double the performance of the market. If I don't think that, then I'm not buying the stock. So that's just something for you to think about. So the majority of our capital is protected because of we're following the ARMR carry trade. A portion of the capital is out in the NASDAQ 100 and the S&P 500, and that's defended with puts. I expect the market to rally if the war gets worse because central banks will support the market. Liquidity will come in. If that's not the case, we've got to react to it. Those are the major points of the strategy that I'll be executing. If you got any questions for me, feel free to shout out. I'm happy to go over it with you before we split here. I think that covers everything that I wanted to share with you. I think it does. Okay. So I know energy prices here's another thought. In case you have a question, you could put it in the comment section. I'm happy to answer it. But ARMR Insiders, of course, I'll meet you guys on the live stream at 9:30. But here's something to think about. I spent a lot of time covering what was going on in Israel over the weekend. And what's really interesting to me, I don't know what to make of this, but there's like a lot of talk about how nobody knew this was going to happen, which can be a little bit disturbing, right? Because where were the security apparatuses of Israel, of the U.S., right? And what's kind of strange to me, and just something I'm thinking about that I'll share with you, is I think I think everybody was caught off guard by it. And I say that because take a look at the financial markets. If you look back at other terrorist attacks, this is a terrorist attack, okay? Don't spend a second trying to pretend that there's a reason for it. We could talk about that some other time. The act was terror. Period. Full stop. Generally, when a terror attack occurs, somebody knows, and equity and commodity markets begin behaving strange before it occurs. Example, 9/11. Airline stocks. Airline stocks were going down for over a month for no reason. Nobody could figure out why are airline stocks getting whacked. Well, we found out, and somebody in the Middle East made a lot of money on that because they shorted airline stocks like crazy. So I just find it very strange that the price of oil was going straight down right into this action. That would not be like the most obvious answer is to be buying oil. Like if oil had been levitating in front of this, that would make sense to me. I find it odd that energy was going straight down in front of this. It just seems strange to me because inevitably this should affect the energy market in a major way. I think that from all I can gather, this is something definitely so many moving parts. Let's stay out of the geopolitical realm and let's just focus on the market. Market lower at the open. I expect it to rally off that level. I expect to get long today. I expect to book profits on my puts, put them out later. That's where my head is right now. If the market takes out the lows of Friday, I will be loading up on the put side and I will be getting short again because I imagine the market will be going a lot lower. That's kind of where it is for me. That's the goalpost. All right, guys. I look forward to working with you at 9:30. Anybody got a question, feel free to throw it in the comment section. I'm happy to answer throughout the day in the comment section of this video. And Armor Insiders, I'll see you at 9:30 on the live desk, and we'll get our day started. Everybody stay safe out there, friends and family in Israel. Remember to be your own smart money. Don't listen to any one talking head. Take everything, put it together, be the smart money, and execute your strategy.